might talk about, on the Aussie side, the Australian side, Woolworths. We started accumulating late last year and went pretty heavy into it post the first half result in February. We've talked to management quite a bit about refocusing the business on the efficiency metrics in the business. Grant O'Brien and the previous manager and the board, more to the point, were focused on sales growth. That's all they cared about. And with sales growth, it's easy, just open stores. Unfortunately, it wipes your margin out at some point, and it caught up with them. So now, if you notice in the last result, they talked about sales per square metre. And if you look at David Jones, when they went from growing to we're focusing on sales per square metre and shrinking store footprint, like they were going to go from 35 stores to 20, and rather than sell DVDs in Elizabeth Street in Sydney, some of the most expensive real estate in the world, they said, why don't we sell a $600 handbag instead? So, that gross margin uplift is material. That's the same for Woolworths. If you look at what they're saying we're not going to roll. They rolled out 32 stores last year, 17 in the last half, actually 17 in the last quarter. And they said we're focusing on sales per square metre. So focus on efficiency, okay? When we look at where they're going with it, they've delivered their first like-for-like sales growth in the first half, and the market's reaction was ridiculous. If you look at the sell side, you guys are obviously very smart because you've got it on a buy. They've gone like-for-like, it's not a proper number. They've fudged the number because sales per square metre was negative for the first half. But they opened 17 stores in one quarter. You don't include, that hurts your sales per square metre metric. And you obviously don't include it in your like-for-like sales growth. So the market's basically got this intellectual disbelief at the moment. They won't look at any positive numbers coming out of Woolworths. And actually, what was it yesterday? It was reported in the paper yesterday. The Nielsen data came out and you saw that Aldi lost share for the first time ever on the East Coast. So they went from 12% share to 11.7%, and they had negative like-for-like sales growth on the East Coast. Now, for a company that's going to take over the world, that doesn't look like it's actually moving with where it needs to be. The market's got, I know Morgan Stanley, not to criticise another broker, they've got basically $18 billion in sales in like 6 or 7 years. They're at 8. I'm pretty sure you can't get that unless you've got like-for-like sales growth. The maths just don't stack up. So what our view is, Coles has run particularly efficiently. If Woolworths run particularly efficiently, which we think they're on that journey, that it'll be hard for Aldi to grow. Because between the two of them, Coles and Woolies, they're like 78, 80% of the market, 75% of the market. So if they're really efficient, how does the next guy come along? So Lidl, it'd be virtually impossible for Lidl to enter the market. Tesco, it took them 5 years to work it out. So that's why Tesco kept just derating the whole time, because they didn't really have the come to Jesus moment and reinvest back in the business. So we think the hard yards is done on Woolies. And also, we always describe Woolies as a company that's long on assets and short on market cap. So they've got the Dan Murphy's business, they've got ALH, the pub group. We want to close Masters, that's done. So they're getting through. Our view is that ALH will be spun out at some point. There's no synergies by adding it to a retailer, a food retailer. We're in discussions with them about, in-specing that, give it to us, because we'll take it, we'll value it. Don't sell it, give it to us. It's our business already, we own it. Dan Murphy's, we've sort of tried to convince them to spin that out as well, because we want them to sell it at the top. That's becoming a bit harder to convince them on. But we like where they're going. The balance sheet we don't think is a problem, which the market's a bit more focused on regarding the dividend risk. So we still like Woolies. We think it's a over $30 stock at some point.